Today we'll be covering the Fed calendar, employment costs, the general inflation rate, and an update on the equity markets, rounded out by a look at the yield curve. Let's get going. Hi, this is Stephen Tuckwood from Modern Wealth. I'm the Director of Investments here, and I'm going to walk you through our June economic update. Let's get going. The end of June brings around the end of the first half of the year, so it's a great point to check in to see where the Fed's at. Wanted to bring in just this chart here to walk through that. As you can see, there are scheduled 8 meetings throughout the year, and we've currently had 4 of those. June's was particularly interesting with a distinct change in verbiage. In recent months, there has been a modest further progress towards a 2% inflation objective versus describing that as a lack thereof in the prior month. We believe that opens the door for potential Fed rate cuts later on in the year. It's a complicated year in that there's July, September, and then the November meeting is right after the presidential election. We think that makes December a likely month for a decision one way or another. One of the key economic indicators that the Fed is honed in on recently is the employment cost index. This is a measure of the cost of employment year over year as a percentage change, focusing on the private sector. As you can see, we had a big spike higher during the post-COVID opening of the economy, and that has somewhat subsided since 2022. However, it does remain persistently elevated above that 4% rate. As long as there's a 4% rate of wage inflation across the economy, it makes general inflation rates difficult to come down to the Fed's target 2%. So this is really what's working against the Fed's ability to cut rates at this time. But if we do see further weakness in the employment cost index, we do think that opens the door again for some Fed action. The federal funds rate has now been at a restrictive level for a prolonged period of time. And it doesn't usually last that long before the Fed then has to intervene and cut rates to stimulate the economy. Again, we're thinking that that time might be coming at the end of the year, especially if we see continued economic weakness throughout the remainder of 2024. Turning to the equity markets, wanted to provide a quick update on June's performance, and this is as of the time of recording, 626, but markets look generally to be higher for large cap US equities. This is going to round out a strong start to the half of the year, up over 15% for the S&P 500. As you can see, smaller mid cap and small cap companies have not performed as well as the US large cap space. And that is a continuation of what we saw in 2023. Splitting the market between growth and value, again, we're seeing growth generally outperform value, which is a continuation of 2023 as well. That bifurcation is also evident when we compare the relative return of the S&P 500 growth index versus that of the value index. And you can see after the 2022 growth sell-off, growth has been on a high trajectory versus the value counterpart. Turning to overseas equity markets, again, has not been as strong a year in developed Europe, particularly as it has here in the United States, but the emerging markets have been a bright spot in the international equity arena. It's been a difficult year for the bond market so far, as we've seen rates generally edge higher, making it difficult for positive returns. We're still slightly negative on the year in the broad market indices on the investment grade side of the picture, although June has been generally positive as the treasury curve has fallen to some extent. The bright spot has been the high yield corporate market, up over 2.5% year to date, and that's thanks to that elevated spread that we get for the compensation for the additional credit risk taken for below investment grade companies. Looking at the change in rates over the last 6 months, the green bar is at the beginning of the year, showing a very steeply inverted yield curve with the 10-year rate sat around 3.9%. At the end of May, the beginning of June, the red bar shows that just how rates had been elevated throughout the year, making it a difficult environment for positive returns across the fixed income space. But we did see some reprieve, and the blue line is to date 626, and lower rates have helped elevate bonds and create a positive likely month for June. Well, thanks for joining us for this month's economic update. I've been Stephen Tuckwood from Modern Wealth. If you have any questions at all, please feel free to reach out. If you like this video, please like, share, and subscribe.